So have you ever thought about starting your own consulting business? Maybe this is the year that you are thinking about retiring, or maybe you just recently retired, or shoot, maybe you're even looking to just kind of change things up from being a normal W-2 employee. Well, we're going to give you some of the key things to be thinking about should you decide to launch a consulting business and how you might be successful in that. We're going to get into that on this week's edition of Dollars and Cents, where we help you make sense of all of life's decisions involving your dollars, including how to maybe better set up a consulting business. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. Make sure you check out our website at nelsonfinancialplanning.com. There you can learn more about us, including our valuable educational resources, such as our book, Next Gen Dollars and Cents. We also have a pamphlet for state of Florida employees that describes all of their different retirement options. And then, of course, a variety of blog posts as well. While you're on the website, you can also check out other members of the team at Nelson Financial Planning, all of whom happen to be certified financial fiduciaries. They stand ready to help you improve your life with a successful and cost-effective financial plan. Speaking of other members of the team, Kristen Costello and Chet Cowhart, both certified financial fiduciaries, will be hosting next week's program. They're going to have a lot to talk about in terms of tax changes, not necessarily for 2025, but for 2024. Things you need to know as you start to assemble together your documents to prepare your 2024 tax return. But first things first here on the program. This, of course, is Dollars and Cents. So important to talk about the markets when the markets are starting to make some headlines. And certainly here at the start of 2025, it does bear a separate conversation given the pretty significant increase in volatility, particularly what we've seen over the course of the past couple of weeks. And at the core of what is happening is you have a variety of economic data that's coming out that ultimately, depending upon how the economic data is coming out and being interpreted, it then correlates directly to what the next move by the Federal Reserve might be. Are they going to lower rates? Are they going to raise rates? So the two pieces of economic data that have come out, particularly over the course of the past couple of weeks, is the little bit or latter one involves the unemployment data. That came out a week ago this past Friday. The U.S. economy added 256,000 jobs, lowering the unemployment rate to 4.1%. That was the biggest jobs gain number since March. So pretty good result, which the problem with that, or you would say, oh, well, how is that a problem? Because if the economy is creating a bunch of jobs, and that's good because, people are working, they have money, and they spend, and they have money, they spend, and then that helps the economy. The issue is that if you have strong hiring, then that suggests that the economy is already strong, and then you probably don't need to reduce interest rates. You don't need to necessarily loosen up borrowing costs. And that would then suggest that the Federal Reserve is perhaps going to stand pat and not continue to cut interest rates at the speed of what you might otherwise expect. Well, needless to say, the market didn't like that last Friday. So a week ago this past Friday, market reacted to that relatively positive economic data in a negative light, with the Dow Jones Industrial on that day going down more than 700 points. So that was a week ago this past Friday. Fast forward to this past week, where you had sort of the next substantive economic data come out on Wednesday, and that had to deal with this, little thing called inflation. So the CPI, the core price index, came out for December at 2.9%. At 2.9%, there wasn't much change in terms of what that inflation rate was relative to what it had been in the months leading up to that most recent inflation data reading. So if we think about the Federal Reserve, and the Federal Reserve has sort of two stated goals. It's supposed to keep the economy going at the kind of the right pace, not too fast, not too hot, not too slow, not too cold, sort of like the porridge that Goldilocks likes, just to kind of that just right, if you will, not too hot, not too cold. But the other part of their sort of dual mandate is to keep inflation low as well. And so then, because that inflation number didn't necessarily show any signs of improvement, that merely 4 days after or 4 business days after the previous Friday in the unemployment data, that then was interpreted as raising the potential hope that the Federal Reserve might cut interest rates to help continue to push inflation down. And so the market responded to that with the notion of viewing it positive, that, maybe the Federal Reserve now they're going to cut rates. And then on that day, the Dow Jones Industrial Average went up 700 points. So that's the very definition of volatility, right? Where one day you're going down 700 points, and then like 3 days later it goes up 700 points. And so the reality is that when we think about kind of what's going on out there right now, particularly here at the start of the year, is we're kind of at this inflection point in terms of what the Fed is actually going to do. And then that uncertainty has created a higher level of volatility, and any external sign, any economic data point that suggests that, the Fed's going to continue to cut, or, the Fed's going to raise, that's going to create these short-term market swings. In fact, kind of the start to the year has sort of created this volatility in a dramatic way. Just a month ago, sort of the futures market was pricing in 2 more rate cuts between now and the middle of the year, and then another one, by December. So a month ago, sort of the tea leaves were saying, there's going to be 3 rate cuts during the course of this year. At the start of this week, that expectation had shifted from just the 3 potential rate cuts to just maybe 1 by the end of the year. That's a pretty big swing in terms of expectations of what the Federal Reserve is going to do. So against that backdrop, so a lot going on here as we start the year. You've got the corporate earnings season that is started in zeal this week, and that, of course, is the period of time when companies announce their earnings for the prior quarter. Usually starts to happen about 3 weeks, 2-3 weeks after the end of a quarter. Give companies time to kind of get their books in order, things like that, and then they announce their earnings for the most recent quarter. So that's kind of what also has started. So far, those earnings are decently strong. In fact, fourth quarter profits, so that's what's getting announced now, is what activity happened in the fourth quarter of last year, expected to come in at their strongest levels in 3 years in terms of corporate profits. So that's the backdrop. Okay, so what's it all mean? And I think the key point is, certainly while a lot of people's focus is going to be on tomorrow, because the air date of this show is the day before the inauguration. Tomorrow also is the Martin Luther King market holiday as well, so the markets won't be open tomorrow. The reality is that while I think a lot of people's focus is sort of on that, I think the focus probably should be more on what the Federal Reserve is expected to do and what they actually will do. That's far more of an immediate determinant of what the markets might be doing in the short term. It's certainly has played out that way here at the start of the year. And the reality is, prior to this week, Dow Jones had given up sort of all of the gain that it had made since the presidential election. So we got some more thoughts on this, including what you should probably do with that backdrop that we've set up here in the first segment of the program. So we're going to take a break and continue here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So here's the backdrop, right? Over the course of just these first several days here in the new year, you've had some different economic data that has come out. The unemployment number, which lowered unemployment down to 4.1%. Then that was followed then a few days later by the inflation data, which showed that inflation stubbornly sticky once it gets into the system, which is a concept that we've certainly talked a lot about over the course of the past few years here on the program. Once it kind of gets in the soup, it's hard to take that ingredient out of the soup. And so the Federal Reserve obviously struggling with that. The inflation data 2.9%, and which is sort of sticky and hasn't necessarily changed a whole lot in recent months. And so what that does is that's creating sort of this inflection point for, okay, what's the Fed to do in that backdrop? When the data is strong, right, strong hiring, then there's an expectation of, okay, well, maybe the Fed's not going to have to cut rates. And then when the inflation data continues to come in at that elevated level, oh, well, then maybe there's an expectation that the Fed is going to cut rates in that backdrop. So what that is doing is that's creating a tremendous amount of short-term volatility. What's it all mean? As we were saying before the break, certainly tomorrow, inauguration. It's also the Martin Luther King market holiday as well. And that's probably where everybody's focus is going to be on, and understandably so. But if you really want to kind of focus on something that's going to have, I guess, more immediate impact in the markets, particularly based on how we've seen things play out over the past couple of weeks, watch kind of what the Federal Reserve may or may not be doing. They're meeting again here at the end of this month in January. So that meeting is coming up not this coming week, but the week after. So stay tuned for that. That'll be a much bigger driver of kind of what you see in terms of volatility in the market. So against that backdrop, what should you be doing at this point? Well, first and foremost, as we always say in this program, be patient. Be consistent. Don't overreact to these short-term swings in the market. If you do, you run a much higher risk of reducing your long-term returns. So be very careful with being reactionary during these periods of time. Number two, what you should be doing, and certainly the start of the year is a perfect time to do that, is check your overall investment allocation, right? Do you have enough of your investments that are designed to sort of weather through whatever short-term market volatility might occur? Now, the way that we like to think about this at Nelson Financial Planning is we always sort of relate it back to the amount of income that maybe you're taking or maybe you plan on taking out of your portfolio. So if you think of it this way, typical portfolio, maybe you're taking 3%, 4%, maybe 5%. So figure out what that is for you, or what you're planning to do in terms of getting income out of your portfolio. And by the way, if you're, a decade or 2 decades or 3 decades away from taking income out of your portfolio, then you can probably just stay where you are at and stay more on the growth side and don't necessarily worry a whole lot about how much do I need to have on the conservative side of things. The further out you are from needing to use your money, then obviously the more growth and consequently, the more potential volatility that can come with that, you can withstand that the longer period of time you have before you actually have to use it. But if you're close to using it, or maybe you are currently using it, then obviously it's a very different analysis. So think about how much money you're taking out on an annual basis. Is that 3%, 4%, 5%, whatever the number is, okay? And then think about it this way, okay, how many years might I want to make sure that if things go crazy and volatility really increases, how many years would I want to make sure that I've got in my portfolio to sort of weather through any of those storms? Because the point of having a diversified portfolio is those parts that are more conservative, right, that don't go down when the headlines are screaming and the markets are going down, well, then that becomes the part of your portfolio that generates out your income during those tougher periods of time. When things are going well, markets all sunny, rainbows and unicorns, well then shoot, okay, take it out of the more growth side of the portfolio. But so if you're taking out 3, 4, 5% and say you need, well, you know what's wrong? I'm comfortable if I knew I had 4 years of coverage or 5 years of coverage or 6 years of coverage. Okay, so if you're taking out 4% and you'd like 5 years of coverage, well then, okay, that's 20%, right? 4% times 5, that's 20%. That you would certainly want to have on the more conservative side of things. Generally, that's going to be things like money markets, cash, short-term bonds, things like that. That allows you to kind of weather through things as best as possible. In our view, you don't necessarily need a whole lot more than that. You know, if you do the math and it's 20%, okay, maybe you go to 25, 30, but oftentimes and far too often we see investors with portfolios that are much, much heavier than that on the conservative side of things. I think, unfortunately, in the financial services industry as a whole, there's kind of more of a formalistic type of an approach that everybody follows that says, oh, well, if you're in 60 or if you're 70, well, you need to have 40% on the cash and bond side of things. Maybe it's 50%, maybe it's 60%. Used to be an old rule that said, take your age, subtract it from 100. That's the portion that should be in on the equity side, and the rest of it should be on the bond side. I think those sort of formulas that the industry uses ignore kind of the reality of how people actually use their money. If the point of saving money and having a nest egg for retirement is then to use that nest egg to generate out income, then how much income you are taking is a far more important determinant of what your investment allocation should be, rather than, oh, my age is 70 and I need to have Y% on the conservative or bond side of things. So it's some important things to be thinking about in terms of kind of how that current volatility relates back to how you should ultimately be diversifying your portfolio and creating the balance inside of your portfolio. We think that this sort of inflection point, or this debate as to what the Federal Reserve is going to do, is going to be a large part of the topic as we go through the year ahead. So it becomes incumbent to really understand that in the short term, you can certainly have a lot of volatility, and we've certainly seen it particularly over the past couple of weeks where we've had a 700 positive swing and a 700 negative swing, just based upon kind of the economic data that has come out. So remember, if you're looking at this stuff on a daily basis, you got to be patient. Far more important to be consistent with your investment allocation. But at the same time, make sure you're doing that exercise of checking out your overall investment allocation. How much do you have on the stock side? How much do you have on the cash and bond side, that more conservative side of that portfolio? That's the balance ultimately you're trying to strike to weather through whatever might be happening in the markets as a whole. Because the reality is that, there's some underlying volatility in the markets at any time, but you need to have that growth component as well, because we're all living longer in today's world. We're going to take a break and continue here on Dollars and Cents with Joel Garris of Nelson Financial Planning. before I forget, yesterday, my wife's birthday. Happy birthday, Stephanie. There you go. We'll hold off on the age. The years, unfortunately, fly by for us, as I'm sure they do for most people. Anyway, it is, of course, the new year. Maybe you just retired and thinking, or maybe this is the year that you are planning to do so, and you're thinking, I want to stay engaged, and I want to keep doing what I am good at. I'm not necessarily ready to give it all up. I just kind of would like to do less of it. So one of the typical courses of action I think many people explore is this notion of setting up a consulting business, right? It seems like a great way to try and monetize, maybe your expertise, the contacts that you've developed over the course of your long working career, plus, of course, your experience. And then, there's a host of studies that say that some form of intellectual engagement in retirement is pretty good for your physical and emotional health as well. But the issue is saying it and doing it are, right, two different things. You may be unsure of how to do it and unsure of how much to charge, unclear of kind of how to do the marketing or what the time commitment actually involves. So with that in mind, we saw this article in the Wall Street Journal that outlined several keys to launching a successful consulting practice in retirement. And we thought it would be good to share some of those with you on this week's program. So first and foremost, and I think this is generally a good rule to live by anyway, not just if you're setting up a consulting business, but don't assume that just because you have a fancy corporate title, that's going to immediately translate to a reputation as a consultant, right? You may think that the clients you work with now, are using you for your individual expertise, and that's probably true. But what's also certainly true is that chances are they have hired your employer, not you specifically. You've just been assigned to them as part of the overall team. So what that means is that you probably want to be prepared in order to make sure that your expertise, your title, if you will, does transfer over into the consulting world. So those involve doing things like speaking at industry events on an individual basis, participating in panels, to sort of think about building your personal brand while you are still working. Maybe that's writing articles under your name, posting on LinkedIn, posting videos or articles where you're explaining some important concept that relates to your industry. The notion is to take the time to develop your personal brand, your reputation, your expertise. It's not enough just to have a title, but you have to have a presence and to develop and market that personal brand. And that's something you can be doing along the way as you get closer to retirement. It's important to kind of start and do some of that prep work ahead of time. Don't assume just because you got a fancy title that you're all of a sudden going to become a consultant to all of these different types of businesses. And then one of the other items that the Wall Street Journal article mentions is to not to dabble, if you will, but commit. To start a successful consulting business, the reality is you're starting a business, so you do have to kind of commit to that. And you have to be engaged with your potential clients really on their timetables, on their deadlines, on what projects they want to have done, when they want to have them done. If you enter into it with the mentality of, I'm going to consult whenever it suits me, whenever my vacation schedule allows me to do, you're probably going to be pretty disappointed in how your consulting business turns out. And in that same vein, it's important to not to take a break before you launch your business. It is amazing how quickly contacts can go cold, sort of not unlike your physical health, right? If you've ever been running, or if you ever did strength training or anything like that, take 2 or 3 weeks off and then try and start it again. See what happens. It's much, much harder to do that. And so ultimately, you certainly do not want to take time off because it can go cold very, very quickly. I can attest to that because I have run marathons before, but it has been a few years, I think 4 since my last one. So this fall I decided to start training again because I do enjoy it. Running, I think if you've ever run, it's one of those things where you either love it or you hate it, and there's nothing in between. For me, I love it. So, but it had been a while since I had trained for a marathon. Much harder this time around with kind of an absence of it. But so far, body's holding in, and marathon's in like 3 weeks, so we're almost there. But anyway, I digress. If you did decide to take time off between retiring and working, whether that's take 3 months, 6 months to rest, recharge, that's probably going to have a major impact on your ability to start a successful consulting business. It's important to really start to lay the groundwork before you leave, right? I mean, obviously you got to avoid conflicts of interest, and I mean, you got to really kind of be careful about that stuff, but it's okay to get organized, right? And to start to build that personal brand that we were talking about earlier. The reality is that more often than not, we see when folks launch these successful consulting businesses in retirement, that more often than not, their current or former employer becomes their first paying client. So important to kind of be thinking about that and not just take a break after you retire. Otherwise, you may find it very difficult to start that consulting business. And then lastly, be careful with kind of the pricing and how you do that, right? Your expertise may allow you to solve a pretty big problem that provides a tremendous amount of value to a client, but it may allow you to solve it within a very, very short period of time. And the issue then is if you're billing on an hourly basis, well, then you could be getting, over delivering and getting significantly underpaid if you're charging on an hourly basis. So think more about charging based on what you're doing. What's the scope of the work? What you're going to deliver. In other words, price based on your value, not necessarily your time. So those are just some of the important considerations to sort of focus on if you're planning to stay busy in retirement with starting your own consulting business. Probably there's something in there for anyone that, regardless of whether they're retiring or not, just going off and deciding to start a consulting business to make sure that you are doing. I think the reality is that, bottom line, don't necessarily make assumptions on it. Don't expect it to be automatic. You are, in fact, starting a business, whether it might not be a business of massive scope. You're still starting a business, and you've got some work ahead that you certainly want to take the time and do some preparatory work before that in order for it to be successful. So some key tips there, if you will, for how best to start that consulting business, which we know there's a lot of folks out there who do that when they get to retirement. So think about those important concepts. With that, we're going to take a break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So as you might well imagine, right, been in the financial services industry now for over 25 years, and you work with a lot of numbers, okay? So I consider myself kind of a, little math guy, if you will. And, it's always interesting to see how people sort of perceive numbers differently depending upon their sort of frame of reference. It's one of those things where I often kind of kid clients, that when their account balances grow, there's a different psychology, if you will, that contributes to how you feel about the impact of kind of market swings. And I think perhaps, at least from a psychological perspective, you think of those perhaps more dramatically. And it's an interesting psychological phenomenon, and we thought it would be a nice tie-in to sort of a conversation earlier in the program about, kind of the increase in volatility that we've seen here at the start of the year. And the reality is it's kind of an intriguing math problem, or at least it's intriguing to me. You may find it boring, but hopefully not. If you experience market volatility of, say, let's just make an easy number, say 10%, right? Human nature is actually going to make you feel that differently, and certainly all the years of dealing with all of the clients that we've dealt with over the years, we can attest to that. It's going to feel differently if you've got $1 million or if you have $10,000. Let me explain. So on $1 million, if you experience volatility on the order of 10%, well, that's a swing of $100,000. On $10,000, okay, that same 10%, so it's still the same level of volatility, but you only feel $1,000. Now, don't get me wrong, $1,000 pretty significant to someone that has 10,000, but the proportionate impact, the psychology of it, when folks kind of think about the actual amounts, right? Same percentage, million versus 10,000, but the actual amount of the dollar fluctuation, 100,000 versus 1,000, that is going to have a different psychological impact on an individual. And we often sort of kid with folks that, well, that's the problem with having a large account. If you had a small account, wouldn't make as big of a psychological impact. The same phenomenon, I think, exists also in the markets, right? If we think about where the markets were, a 1,000-point swing, if you will, in the Dow Jones Industrial Average. When I started in this business, I think the Dow was around like 9,000, right? So 1,000-point swing, that's an 11% swing. Today, that same 1,000-point swing in the Dow is only about 2%. And the same thing holds for the S&P 500. The S&P 500 closed above 6,000 for the first time last November. And for it to go from 1,000 to 2,000, it took like 16 years. To go from 2,000 to 3,000, it took like 5 years. To go from 5,000 to 6,000, it took like 1 year. So that's kind of the other part of the concept, is that as the number gets bigger, then the absolute value of that point change doesn't have as significant or as material of an impact. So I think one of the things that this really underscores is the importance to sort of always have perspective. That's why we do the show each and every week. That's why we sat down and wrote the book Next Gen Dollars and Cents, is to really help folks get that perspective, because certainly those monetary shifts are certainly significant and important to recognize that psychological impact that comes with that. But it's also important to have perspective on that as well. So, just an interesting thing that, as I was thinking about the volatility that has kind of spiked up a little bit here at the beginning of the year, how that impacts on investors and investor psychology is always interesting to see how that plays out. Speaking about how things are going to play out, next week on the program, we're getting closer and closer to tax time. So Kristen and Chet are going to be hosting. Kristen Costello, who is a CPA, one of our certified financial fiduciaries, also a certified financial planner, going to be joined by fellow certified financial fiduciary Chet Cowhart on next week's program. They're going to talk about the tax changes for the current filing year. Now, remember, you file your taxes this year, 2025, but they're actually the taxes for the year 2024. And so while there wasn't kind of the litany of tax changes that we certainly expect this year coming forward, there were certainly some significant tax changes to be aware of as you are starting to organize those documents to prepare your 2024 tax return. I know at our office where we actually do tax preparation for our clients, we were getting out in the mail all of the different tax organizers, things like that, to sort of start that process. Know that there are still, even though there were not a slew of changes like sometimes there are in some years, there were definitely some changes. So you want to be aware of that. Good program to make sure you listen in on next week as they go through some of those tax changes that are applicable for the return that you're getting organized and you're going to be filing right now. Of course, it is not too late, even though that we are in the year 2025 now. It's not too late to fund last year's IRA or Roth contribution. Remember, you can fund those all the way up until April 15th for the prior year. Can't go past April 15th, but you can go all the way up to April 15th. The limit for those IRAs in Roths, its combined aggregate limit, if you're funding an IRA or a Roth, it's $7,000. If you're over 50, you get to do an extra $1,000. Those numbers stay the same for 2025, so no change there. That is an increase over the $6,500 that existed in the year 2023. Just know that if you're sitting in 2025, you can actually, of course, fund 2024 all the way up until April 15th. And you can also, of course, because we're in the year 2025, you can also fund 2025 right now as well. So a good opportunity to maybe catch up on things in terms of funding those retirement accounts. Remember the key concepts between those two types of accounts, right? An IRA is traditional IRA means that when you put the money in, you're supposed to be able to get a tax deduction, save on your taxes, so that contribution is done on a pre-tax basis. When you use it down the road in retirement, well, you're going to pay taxes as you take that money out. So one of those kind of mechanisms where you're saving now, paying later. The Roth, sort of the flip of that. When you put money into a Roth, you don't actually save anything on your taxes right now. It's because you're using after-tax dollars. But when you use it in retirement, then those dollars and the growth of those dollars come out to you tax-free without any taxes. So that's one of those things where you pay now, save later, if you will, in terms of how that breaks out. Generally, the lower the income tax bracket, right, the more you want to say, well, if I'm in a low tax bracket, maybe I'll save now. I'll pay now and save later, and then that would lead you to doing more on the Roth side than the traditional side, because if you're in a lower tax bracket, maybe you don't need that tax deduction that comes with that IRA. Also, coming this week at the office, the first of the year, we do client educational events each and every quarter for our clients. That one's going to feature sort of a fireside chat format where myself and the speaker, who's a senior equity strategist from a major investment firm, is going to be going through a range of topics ranging from the economy and investment outlook to AI, and of course the inauguration and all of those kinds of things. So if you are a client, make sure that you RSVP for that. Those are educational events designed specifically for our clients only. And so if you want to go, you've got to become a client. If you're not a client, question is, why not? Why shouldn't you be at Nelson Financial Planning? So important to get advice and perspective on the range of issues that we talk about this week on the program and every week here on the program. If you have questions about anything that we've talked about here on the program, give us a call. Happy to answer any of those questions, and even more importantly, take the time to set up an absolutely free conversation. Remember, we don't charge for those. Happy to sit down and talk with you about whatever it might be that you want to chat about in terms of your financial situation. With that, we're going to get on out of here and conclude the program. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning.